Okay, let's start off chapter 11 and we're talking about current liabilities. So, pretty cool stuff, everyday stuff actually, when you look at it. It's just something that we have every day that we use in accounting. And you've seen it already. You've seen accounts payable, you've seen all sorts of things. It's just one of those deals where, yeah, we know that those things happen all the time and we need to set them up. So, current liabilities. Now, every business has debts. Those are known as liabilities. So you have debts. I'd love to hear of someone who doesn't have any debts right now. It's funny, we get a job, we get out of school, or maybe we buy our first car. And all of a sudden we've got debts. We've got a car loan, we've got rent that's due, we've got a credit card bill, we've got something. Maybe we've got some student debt. All of that are liabilities. Now, current liabilities are those amounts that are expected to be paid within 1 year of or an operating cycle. Now, first off, we're going to say an operating cycle can be a year, it can be less, it could be more. But generally speaking, in this course, when we talk about current liabilities, we're talking about something that is expected to be paid within 1 year. Now, you know about different kinds of current liabilities already. You know about accounts payable. You know a little bit about loans and that sort of thing because you probably experienced them yourself. But there's two different types really of current liabilities that we look at. Ones that we know the amount and ones where we don't know, but maybe we can estimate the amount. We're going to have a look at those as we move along here. So first of all, starting with sort of known current liabilities. Accounts payable, short-term notes payable, short-term bank loans and operating lines of credit, GST, oh, the horrible GST and HST and all that bad stuff. We're going to talk about that. Current portion of long-term debt, what's that mean? We're going to have a good look at that. And accrued expenses or accrued liabilities, unearned revenues, customer deposits, all stuff that you will see every day working in an accounting department. The more relevant things usually are towards the top of this particular slide, but we're going to talk about all of them so that you understand them all. Now, you already know about accounts payable. You saw that when you were buying inventory on account. So if you were buying some merchandise for resale, your entry would have been to debit inventory, credit accounts payable. And so that's a pretty normal entry. You're going to see that a lot. Or you'll see the purchase of something. For example, you might buy some office supplies on account. And so those would be expense items, and the entry would be to debit office expenses and to credit accounts payable. And then subsequent to that, somewhere down the road, the company or business that you work for would pay those payables. And the entry to get rid of those is to debit accounts payable, to eliminate it, and credit the bank to make the payment to whoever it is you're paying. Short-term notes payable are very interesting. They're by nature due within 1 year. So remember we said current liabilities have to be due within 1 year. Well, that's exactly the case here, that they would have to be due within 1 year if they're short-term notes payable. And they're going to be in the current liabilities section of the balance sheet. So we know they're due within 1 year. Often they relate to the purchase of inventory. Once in a while, you might see it related to some sort of property, plant, and equipment. But generally speaking, it's related to the purchase of inventory, sometimes called dating inventory. And it's usually got an interest rate associated with it if it's going to be for a significant amount of time. Now, just an example of this. We see it in the RV industry where RV manufacturers want to build RVs over the entire year. But people tend to buy RVs in the spring. They really get on that bandwagon right then, get all excited. So what happens is the manufacturer of those RVs sells these RVs to an RV dealer, and the dealer signs some form of short-term note payable saying, I will pay for this inventory at a later date. So you could have that inventory showing up at a dealer in December, but not be sold until April, in which case the manufacturer says, you don't have to pay it right now. You can pay me interest on it at, say, 1% a month or something like that. But we're going to take this inventory, and we know you're going to be able to sell it April, May, or June. Well, let's say April the 1st, we need you to pay for it, or May the 1st, we need you to pay for it. Sometimes that's called dating inventory, but it's very popular in certain industries or certain retail operations. Jewelry stores, great example. They sell just a ton of jewelry in December. Everybody wants to go and buy something in December, it seems like. So manufacturers will sell them inventory to sell in December, but will produce it in July and ship it in August to that jewelry store. But they'll end up signing some sort of note payable saying they'll pay that down the road. Now, short-term bank loans and operating lines of credit are very interesting too. And again, real-world stuff. This happens. You can have bank loans that are for a specific amount, and they'll be short-term in nature. But they're short-term in nature because often they have a demand feature to them. So let's go through an example here. So let's say that we need to buy a bunch of inventory. We're buying all sorts of inventory, and we're not going to sign a note payable with the manufacturer, but instead we're going to go to our bank and say, look, we're buying $50,000 worth of inventory. Lend us $50,000 in a short-term bank loan, and we'll pay that bank loan off over the next year, say. So that would be perfect. That would work out fine, and we pay that off over time. But oftentimes that short-term bank loan has a feature on it that says where the bank can say, we want our money whenever we ask for it. So we're not generally going to ask for it, but if your numbers don't look good, or there's a change in the market, or there's COVID-20 all of a sudden, then in those cases, the bank can call the loan and say, no, we want all our money right now, which can put a business into really tough shape. Accounts receivable are another item that can secure an operating line or a bank loan. If you've got $100,000 in accounts receivable in a business and you'd like to get that money and put it to some good work, sometimes what you can do is you can go to your bank and say, look, we've got this $100,000 in receivables. We know it's going to come in really soon. Will you lend us $100,000 or $60,000 or $50,000 against these receivables so that we can pay for those, so that we can use that money to maybe go buy more inventory, maybe pay some of our suppliers, whatever it is. But often that will also have a demand feature. And it's that demand feature that makes this a current liability, in that the bank or lender could ask for that money on demand. So kind of a challenge there for a lot of companies when they've got to do that. Now, if it's a bank loan as opposed to a line of credit, then the loan may have some periodic principal payment requirement. So, for example, maybe again it's a $100,000 loan, and we've agreed to pay $10,000 a month on that in principal. We'll pay whatever the interest is. We have to do that, but we can pay, say, $10,000 a month in principal, and the bank loan would tell you what you do and don't have to do in that case. Lines of credit tend to go up and down depending on the bank balance. So you borrow more in a line of credit if you don't have much cash in the bank. But if you collect your receivables, for example, then your operating line would go down. They will definitely have that sort of fluctuation, and that demand feature is going to be there on both of those loans, and that's going to make them current. So GST, HST, sales tax, the current portion, well, how about just sales tax? We're going to do a special video on that. It's a big item, and you're going to see it every day. So we're going to talk about that shortly. Current portion of long-term debt. Now, if we buy a vehicle, or we buy a truck, or we buy a piece of equipment in our business, oftentimes we can't pay for that all at once. We just don't have the money to do it. We actually expect that equipment will last for quite a while. Well, that's all good. We want that. We want to match that if we can. A lot of times, match the financing or the debt with the asset. When you do that, you'll figure out very quickly that if you want to have a very good view of where you are on a current basis with your debt, is you're going to have to determine how much of those loans you're going to have to pay within the next year. And just the principal portion is what we're looking at. We know that there's going to be interest that's going to accrue, but we want to know how much of those long-term debt loans we're going to have to pay in the next year. That shows up as a line on the balance sheet as a current portion of long-term debt. And it helps the financial statement reader anticipate what's going to happen in the current year in terms of loan repayments. Really important to them. Excuse me. Accrued expenses. Now, these are sometimes called accrued liabilities, but they're amounts for which we haven't got an invoice just yet, but we know we're going to have to pay this. So perhaps we've just done a major rebuild on an engine for a big piece of equipment. Well, that particular cost of doing it, the shop that's doing it said it was going to cost $50,000, and they're pretty much done the work. And so we've come to the end of the year, and we haven't got a bill yet for the $50,000, but we know it's about right around there. So for that, we can accrue the expense and for the $50,000 in our liabilities and claim that as a current period expense in payables. So real value in doing that, because it gives the reader, the financial statement reader, a really good idea of what sort of costs haven't quite hit the balance sheet yet. But it does say that, yes, maybe $50,000 is a specific or is a big enough amount that it means something to the reader. We need to accrue those things. Unearned revenues are basically monies that customers have paid in advance for the future delivery of goods or services. So think of this as a payment that maybe a company has signed a contract and says, we'd like you to build us this big piece of equipment, and it's worth $10 million. And you say, that's great, yeah, but we're not going to undertake a $10 million project without you putting down some money on this, so we know you're serious. So you need to put down, say, 30% of the cost of the particular unit. So what will happen is we'll get that $3 million from the customer, in other words, 30% of $10 million, and we'll pop that into our bank account, and we'll record it as as unearned revenue or as a liability. So we haven't spent anything yet. We haven't done anything at all. We recorded it as unearned revenue. And if something happened and we didn't build that piece of equipment, I don't know, maybe we had a fire at our plant or something went sideways here, then we would pay that money back to the customer. So in that case, we've got a challenge there where we end up setting up as a liability saying, we're going to show this as money that we've got, but we haven't earned the revenue yet because we haven't incurred the expenses. And while we'll see some people tie the actual expenses to the revenue and bring it into revenue as as the expenses are incurred, it's also possible you can just show the amounts in inventory that you spent and you have all this unearned revenue. And then when you've actually got it done, you bring all of the unearned revenue into revenue and all of the expenses into expenses. And then that's called the completed contract basis. That's another way of recording expenses and revenues as they come in. Customer deposits. Let's go back to the jewelry store. Somebody comes in and thinks they want to do some good work and buy a ring. Well, awesome. That ring is going to cost $3,000, and they're going to have to bring it in from who knows where. Well, that's fine. We'll take that maybe $1,000 deposit on that particular sale, and we'll put it in our bank account, again, to make sure that they're serious. And we'll take that money and wait until we get that inventory item in, and then we'll bring in that deposit into revenue and record the inventory as a cost of sales at that point as well. So pretty interesting way of looking at it, but customer deposits happen all the time in retail, and just know that it's going to be there. So we've got more coming up here shortly, but I hope you enjoyed this section on current liabilities, specifically ones of a known amount.